So kind of concluding the last part of this video talking about technical analysis, let's continue looking at the market itself. So we have what's referred to as market breadth. This is the number of rising issues relative to the number of declining issues. So the advanced decline ratio is just the quotient of those. You take the number of rising issues and you take the number of declining issues and you divide them. If it's greater than one, the market's considered bullish. Less than one, it's considered bearish. We have something referred to as the trend index. Here's where we take that advanced decline ratio, number advancing divided by the number declining, but then you also divide that by the volume of the upward moving stocks divided by the downward volume. Again, this trend ratio is an indicator of market imbalance, right? So again, it might be overbought, right? If this ratio is less than 0.65, it says maybe there's too much buying going on, right? If it's greater than 1.1, then that means maybe the market is oversold. And of course, if there's too much buying going on, if it's overbought, that might be an indicator that the market will fall. So again, here we have our ranges for this particular number. So from 0.9 to 1.1, that would be a neutral kind of market. That's where we expect it to be on average. Moving in either direction, again, might give us a signal that maybe the market is considering a change or is in a change. So how we can do this in Excel, again, if you look at our formulas here we have the New York Stock Exchange and NASDAQ, the relationship between those two markets. Here's advancing, declines, how many were unchanged, there's the total. So if you want to know the AD ratio, right, the advanced decline ratio, that's C3 here, right, C3 for NASDAQ divided by C4. Right? The trend ratio. Again, we know what these numbers are here. This is C3 divided by that's that number above. You divide that by the volume advancing, volume declining. So we see here that our numbers are in that 0.6 to 0.61 range. Going back one, we see we're up here, 0.6 to 0.1. We know we're less than 0.65. So that might be an indicator that the market is very bullish. So what are some other buy-sell indicators, right? Technical analysts, they watch different indicators to try to figure out when to buy or sell. Individual investor actions are considered a measure of emotional investing, right? This makes an individual investor measure a contrary indicator. So whatever the individual is doing, you should do the opposite, right? The idea here is people are wrong most of the time. So if everybody is making a similar decision, the idea here is most of the time they're wrong. So odd lot indicators, right? How many trades go on using odd lots to gauge investor sentiment or investor ideas? Institutional investors use round lots. Individuals use odd lots, less than 100 units per each, right? So again, the idea here is if you're looking at odd lots, if the odd lot purchases are increasing, that's telling us that investors, individuals, are buying. That might be an indicator that we would want to sell. Again, we can also do this with mutual fund flow indicators, right? These show mutual fund inflows and outflows. Most individuals are the ones who are buying mutual funds. So it is an indicator of individual investor analysis and decisions. brokerage account credit balance indicators, right? If the credit balances are going up, buying power that resides, this is the buying power that resides with the consumers. If that's increasing, that means investors have money. They're hoarding it. They're not keeping it, which means they're not investing. This might be an idea. If we're not investing, maybe we should think about investing. Confidence indexes, an indicator investors' mood based on bond yields. Again, this is measured between 1 and 100%, right? So if people are putting a lot of their money into bonds or bond yields are increasing, that means there's demand for bonds, then that is telling us that what? Maybe investors all are buying bonds, they're not buying stocks. Maybe we should be buying stocks. Again, it's the opposite. It's a contrary strategy, if you will. The put call ratio. We'll talk about options a little bit later. But if you buy a put, you're betting the stock price goes down. If you buy a call, you're betting the stock price goes up. So the ratio of this volume here, right? A high ratio is very pessimistic. It means what? More people are thinking that it's going down than it's going up. So again, I know this sound of a little illogical, but we need to remember that investors don't invest with their heads. Investors invest with their hearts. It's an emotional decision. Quite frankly, it's actually even a consumer decision, right? It's not based necessarily on investment thought and strategy. So here we have the put call ratio for the S&P 500. So here's the equity put call, and here's the S&P 500 index. So you can see as the number goes up, we also see that when the put call went up, the market went down. We can see that there are indicators of when that happens. When these little movements happen in the put call, that's an indication that something might be happening in the S&P 500 index. And as this number has continued to go down, that implies what? That implies that the stock price in the market has gone up. So now this number should be at historically low numbers since the stock market's at historically high prices. What can we learn from ownership data, right? Inside ownership. These are shares that are owned by those with access to key information. When they sell, this could be telling for a technical analyst, right? If the people who know what are going on are selling, that might be a signal that bad things are going to happen. We can look at institutional ownership, right? Lots of pension funds, mutual funds, insurance companies are majority owners of the U.S. market. So again, technical analysts watch their stock moves because again, that in the end can impact price. We also have what we refer to as the degree of short sales. Sales of borrowed stocks by those who think the stock's going to decline, right? We may want to behave as these sophisticated investors, right? So if there have been short sales and now people are buying the stock back, the reason they're buying it back is they're thinking it's going up. Who does short sales? The average person doesn't do a short sale. These are more advanced types of investors, more knowledgeable investors. So again, we should follow them when they're doing short sales. So this is something that happened not too long ago. It's what's referred to as a short squeeze, right? So stock investors look for large short sales in stock, and then they buy the stock. That pushes up the price. So the short sellers need to cover their position by purchasing the stock at a higher price. This is what's called a short squeeze. This is what happened to GameStop in 2021. Lots of institutional short sales were in the market. Retail investors using something called Reddit purchased lots of stock. They increased the stock price from $19 to $4.83. So institutional short sellers lost millions, right? So again, uh, I think the important part to understand here is that um, what the individual does really drives the market price, right? That individuals are really in the driving seat when it comes to pricing. Sentiment surveys. These are surveys that help us determine investor optimism. Sorry about that. So there is the AAIIA, I think that's the American Association of Individual Investors, has an investor sentiment survey. It's a weekly poll. Investors are telling us how they feel. The Consumer Confidence Index gauges consumer attitudes and buying intentions. There's the University of Michigan Consumer Sentiment. Again, this surveys consumers on their spending and saving patterns. And the idea here is these are polls of individuals telling us how they feel. We can use this information to help us. So again, the AAI survey shows some bullish percentage minus the bearish percentage. That's essentially how they calculate their number. What percentage of investors are bearish? Subtract from that the percentage that are bearish. Gives us an indicator, right, of bull markets and bear markets. This looks at the S&P 500 here and investor sentiment over those time frames. We also can see this is the S&P 500 index is the blue line. The red line here is the consumer sentiment. And it shows us in general how investors feel about the marketplace itself. If we know how investors feel, we can decide how we want to move going forward. One last thing to talk about is something called momentum. Momentum is the speed of price changes. Some believe the price changes start slowly, then they pick up speed, then they slow it down. If you can track and profit from these trends, right, you understand when you can make trends. So the rate of change indicator shows price changes over 10 to 12 days. So a rising ROEC is a bullish signal. Falling is bearish. So how do you do it? It's the current price divided by the price, say, N days ago, minus 1, right? So this really is just a change over the last couple of days. Again, if this number is rising over time, if we do this every day, then we would see then whether or not we thought that the price was increasing or decreasing over time. The moving average divergence indicator shows a relation between two indicators. So here we're going to look at a 26-period exponential moving average minus a 12-period exponential moving average. And then the second indicator is the 9-day exponential moving average. So again, we calculate this, right? The exponential moving average is 2 divided by n minus 1, n being the number of periods here. You take the closing price minus the previous experiential moving average, and then you add the previous moving average. Again, this weights these two things together. And the idea is we want to see if there are changes in the marketplace. So here we see that's this at the bottom, MACD. This gives us some idea of the changes. We can see here that the market's rising. These things are above 150. Then all of a sudden they're down. It seems here that in the middle here, This 150 to 130, 148 range seems to be the line of demarcation. Above that, stock prices are probably rising. Below that, stock prices are falling. So what is the value of this technical analysis, right? I mean, if markets are efficient, if prices really are reflective in with information, then there should be very little value to technical analysis. However, we know that there is some inefficiency in the market. So the questions are, can you pick winners or losers? Maybe you can, but do you make enough to actually compensate for risk? Do you make enough to compensate for the commissions and the taxes that you may have to pay? So technical analysis is a valuable tool for traders, but it should be used alongside other investment strategies. Understanding market psychology and integrating technical indicators can enhance your ability to make informed decisions. I know that was kind of a confusing chapter. I apologize for that. My knowledge here is limited, but I do see some usefulness in trying to understand where the market is going. If the market in general is rising, one of the things we've said in a previous video is if the market is rising, all ships rise in high tide. Not all ships are floating in low tide, right? So it gives us some indication of when we should be buying and when we maybe should not be buying. Look forward to seeing you in the next video.